Hello folks, I know that these days the retail investors especially is in a panic mode. The market is crashing. One day it is giving an uptrend, but then majority of the days it is going down. Your portfolio also may have taken a big dip because of the ongoing war, the US-Iran war. So as I informed you, I have been buying stocks these days since the market is down, and this is how a value investor really makes sizable profit. But then one important concept I wanted to tell you is that going forward, these stocks will not be available at a cheaper valuation which we currently have. So this means that you are missing an opportunity to enter into stocks at sensible prices, and you are probably missing the multi-bagger returns it is going to give going forward. So let me decode it for you so that you don't miss the opportunity of buying the share at the lower valuation and then don't miss the probable multi-bagger journey. End of the day, valuations are largely dependent on the interest rates. So for an example, our interest rate set by the various banks, which is again dependent on the repo rate set by the RBI or the central bank. So if you see, earlier the interest rate during our childhood, it used to be around 14%. Now it is around 6 to 7%. And as India grows in GDP, grows larger and larger and does good, the GDP becomes bigger and it grows towards the ultimate reality of a developed nation. Interest rates will be much lower. So earlier 14%, now 6%. Going forward, it will be 2 to 3%. As low as that. Similar to developed nations like China and US. Say after 10 years, the India GDP will be much larger. It will be grown into a larger size. So the requirement of capital, well in that case taking debt. So normally companies take debt for getting capital to invest in their capex. Company does new projects, sets up various plans, and this capital requirement is met by lending money from banks. So these interest rates, if they keep it higher, then already the capital requirement is less for them as they have already grown in size, then nobody will borrow. So the borrowing to happen, as the demand is less, the bankers will have to reduce the interest rates. Obviously the repo rate will be reduced by the central bank going forward as a cascading effect. So this lesser interest rate will lead to cheaper borrowing, and this borrowing will again lead to catapulting the GDP, because lesser borrowing means lesser interest rate. So the profits also is increased because the interest cost is reduced. So this is really good for the capital market. Currently, if you see, the investment by Indian population is around just 10%, 8 to 10%. In US, it is around 60%. 60% of the population is invested through various demat accounts into stock market, into equity market. Ours is just 10%. A long way to go. So 10% and 60% is like 6 times. So as the interest rate reduces, the FD returns also reduces, the fixed instrument return also reduces, which means there is no place for the investors to invest. So no FD means the money flows into the capital market, where the returns are high, the valuations are high, because as the interest rate reduces, if you see models like DCF, discounted cash flow model, etc., the valuations will be higher. So higher valuation means who has invested now will get much higher returns going forward, because the valuation increases as the interest rates drop, as the economy grows in size. And also you should note that as the interest rate is low, so the government will also take a lot of debt. Just like US, they have $39 trillion. So the interest payment is so high because interest rates are so low. So they take loan and grow the economy. So high debts, especially what India is having, below 80% debt to GDP ratio, unlike more than 125% for US. So as far as the debt is taken to grow the economy, that is good. So going forward, as the investors also catapults from the current 10% to say 50-60% just like US, then the investment inflow also increases. Also, as you see, there is a lot of FIA outflow from the market, but then domestic institutions and retail investors is holding the market. Unlike old times, the liquidity has increased so much that money is enough to hold the market. And Nifty or any indices, if you see, it is holding their position even if the FIAs are selling. So that concern is no more there. So as I mentioned, interest rates reduces going forward, the stock valuation also increases a lot, and the valuations of the market or the stocks which you like is also going to be very high. So currently, take this opportunity to buy stocks and hold for a very long period. As the valuations multiplies, as the interest rates goes low, the GDP increases, India becomes a large economy, then you can participate in the India growth story, and your stock portfolio also become much larger, which you cannot even imagine as of now. So stay invested. See you next video. Till then, happy investing.